The secret behind capital growth: how the rich build wealth over time. Part 1. The foundation of capital growth. Welcome to All CEO Academy, where we break down the ideas, strategies, and principles behind successful businesses and smart investing. Let's begin. Imagine waking up one morning and discovering that while you were sleeping, your wealth quietly increased. No extra hours at work. No overtime. No second job. Just growth. Now, before you think that sounds impossible, here's something surprising. This is exactly how many wealthy people build their fortunes. Their money isn't just sitting in a bank account. Instead, it's invested in assets that have the potential to become more valuable over time. Think about this for a moment. Two people earn exactly the same salary. They live in the same city, have similar expenses, and even graduated from the same university. 10 years later, one owns multiple investments, has a growing net worth, and enjoys financial freedom. The other is still living paycheck to paycheck, wondering why it feels impossible to get ahead. What happened? Did one person simply get lucky? Did they win the lottery? Not at all. The biggest difference was understanding one powerful financial principle that many people overlook: capital growth. Capital growth is one of the most important concepts in business, investing, and wealth building. Yet surprisingly, most schools never teach it, and many people go through life without truly understanding how it works. That's unfortunate, because once you understand capital growth, you'll start looking at money differently. You'll begin asking better financial questions. Instead of wondering, how can I earn more this month, you'll start asking, how can I own things that become more valuable over time? That small shift in thinking can completely change your financial future. In today's video, we'll explore what capital growth really means, why it's the foundation of long-term wealth, how successful investors use it to their advantage, and how you can begin applying the same principles, even if you're starting with very little money. By the end of this video, you'll understand why capital growth is often considered the secret behind lasting wealth. Let's dive in. What is capital growth? The term capital growth sounds complicated, but the idea is actually very simple. Capital growth happens when an asset increases in value over time. An asset is anything that has value and can potentially make you money in the future. For example, imagine you purchase a small piece of land for $100,000. You don't make any major changes to it. You simply own it. Over the next 10 years, more businesses are built nearby. Roads improve. New homes are constructed. More people want to live in the area. As demand increases, the value of your land rises. Now it's worth $180,000. Your investment has grown by $80,000. That's capital growth. The same principle applies to many other investments. Maybe you buy shares of a successful company. As that business earns more profits, attracts more customers, and expands around the world, investors become willing to pay higher prices for those shares. Your investment increases in value. That's capital growth. Or perhaps you start a small business. At first, it's only worth a few $1,000s. But after years of hard work, your customer base grows, your profits increase, and your brand becomes well known. Now someone offers to buy your company for millions. Again, that's capital growth. The important thing to understand is that wealth isn't only created by earning income. Real wealth is often created by owning valuable assets that continue growing over time. Income versus wealth. Many people confuse income with wealth. They're not the same thing. Income is the money you earn. Wealth is the value of what you own. Imagine someone earning $150,000 every year. That sounds impressive. But if they spend almost everything they earn on expensive cars, luxury vacations, and designer clothes, they may actually have very little wealth. Now imagine someone earning only $70,000 per year. Instead of spending everything, they consistently invest in businesses, stocks, or real estate. Year after year, those investments grow. Eventually, their assets become worth far more than their annual salary. Who is truly wealthier? The second person. This is one of the biggest mindset shifts you can make. The wealthy don't simply focus on earning money. They focus on owning things that grow in value. That's why many successful entrepreneurs and investors often say, don't just work for money. Make your money work for you. What they really mean is this. Use your income to buy assets. Then allow those assets to grow. Eventually, those assets begin creating wealth on their own. Why most people never experience capital growth? If capital growth is so powerful, why doesn't everyone become wealthy? The answer isn't intelligence. It's behavior. Most people are taught to earn money and then spend it. The moment they receive a paycheck, they begin thinking about what they can buy. A newer phone. A bigger television. More expensive shoes. A luxury car they can't comfortably afford. Many of these purchases lose value almost immediately. Instead of buying assets that appreciate, they buy liabilities that depreciate. As a result, they work harder each year just to maintain their lifestyle. Successful investors think differently. Before buying something, they ask themselves one important question. Will this become more valuable over time? That single question often separates consumers from investors. One group spends money. The other builds wealth. And that's where the journey toward capital growth truly begins. Part 2. Why capital growth creates wealth. Why capital growth is the foundation of wealth. Now that we understand what capital growth is, let's answer an even bigger question. Why is it so important? The answer is simple. Capital growth allows your wealth to increase without requiring you to work more hours. Think about the average person. Most people exchange their time for money. They work 8 hours a day, 5 days a week, hoping that their next paycheck will help them move closer to financial security. There's nothing wrong with working for a living. In fact, it's where almost everyone's financial journey begins. But here's the challenge. Your time is limited. There are only 24 hours in a day. No matter how talented or hardworking you are, there comes a point where you simply can't work any more hours. That means your income has a natural limit. Capital growth changes the game. Instead of relying only on your salary, you begin owning assets that can increase in value year after year. While you're at work. While you're spending time with your family. Even while you're asleep. Those assets have the potential to become more valuable. That's why many wealthy people don't chase more hours. They focus on owning more valuable assets. The difference between spending and investing. Let's imagine two friends named Alex and James. Both receive a $10,000 bonus from work. Alex immediately buys the newest smartphone, expensive designer clothes, and a luxury vacation. For a few weeks, everything feels exciting. But after a year, the phone is outdated. The clothes have lost much of their value. The vacation exists only as memories. Most of that money is gone. Now let's look at James. Instead of spending the entire bonus, he invests it into assets with long-term potential. Maybe he purchases shares of growing companies. Maybe he invests in his own small business. Or perhaps he buys equipment that helps him earn more income. 7482. Years later, those investments may be worth much more than the original $10,000. Both friends earned the same money. But one chose temporary satisfaction. The other chose long-term growth. This is one of the biggest habits that separates investors from consumers. Consumers ask, "What can I buy today?" Investors ask, "What can grow tomorrow?" That difference may seem small, but over decades it can completely change someone's financial future. How the rich think about money. One of the biggest misconceptions about wealthy people is that they simply earn more money than everyone else. While higher incomes certainly help, that's not the full story. Many high-income earners still struggle financially because they spend almost everything they make. At the same time, many millionaires built their wealth gradually by consistently buying assets instead of liabilities. Successful investors understand a simple principle. Every dollar has a job. Some dollars are spent. Other dollars are invested. The invested dollars become workers. Imagine every dollar as a tiny employee. Instead of sitting in your wallet doing nothing, each invested dollar goes out into the world trying to earn more dollars for you. Eventually those new dollars become workers too. This process continues year after year. That's how wealth begins to multiply. The goal isn't simply to earn money. The goal is to build a team of financial workers that continue creating value long after you've earned the original income. Assets that can experience capital growth. Capital growth isn't limited to just one type of investment. It can happen across many different assets. Let's look at some of the most common examples. Real estate. As cities grow and demand increases, properties in desirable locations often become more valuable. That's why many long-term investors purchase homes, apartments, or commercial buildings with future growth in mind. Stocks. When businesses grow their profits, expand into new markets, and innovate, investors often become willing to pay higher prices for their shares. Companies like Apple, Microsoft, and Amazon became valuable because they created products and services millions of people wanted. As those businesses grew, so did the value of their shares. Businesses. Building your own business is another form of capital growth. A small coffee shop may begin with only a handful of customers. Years later, it could expand into multiple locations, hire dozens of employees, and become worth millions of dollars. The owner's wealth increases because the business itself becomes more valuable. Skills and knowledge. Many people don't realize this, but your skills can also create capital growth. Learning marketing, programming, sales, leadership, or financial management can increase your earning potential for years to come. Unlike many physical possessions, knowledge often becomes more valuable the more you use it. That's why successful entrepreneurs constantly invest in learning. Patience, the secret ingredient. One of the biggest mistakes beginners make is expecting instant results. They buy an investment, wait a few weeks, then become frustrated because nothing dramatic has happened. But capital growth rarely works overnight. Imagine planting a tree. You wouldn't expect it to grow 10 feet by next week. Instead, you water it consistently. Protect it. Give it sunlight. Year after year, it grows stronger. Investing works much the same way. The greatest investors understand that wealth is usually built through consistency, discipline, and patience. Small gains repeated over many years often outperform risky attempts to get rich quickly. That's why many experienced investors stay focused on the long term instead of reacting to every headline or short-term market movement. The biggest lesson so far. If you remember only one thing from this video, remember this. Your salary can help you earn money. But your assets are what help you build wealth. The earlier you begin collecting valuable assets, the more time they have to grow. Time is one of the greatest advantages an investor can have. Every year you wait is a year your investments lose the opportunity to grow. That's why understanding capital growth today can have a powerful impact on your financial future tomorrow.
Part 3. Building long-term wealth. Common mistakes that prevent capital growth. Now that we've explored why capital growth is so powerful, let's talk about the biggest mistakes that stop people from experiencing it. The first mistake is wanting results too quickly. We live in a world where everything happens instantly. Food is delivered in minutes. Movies start with a click. Messages are sent in seconds. Unfortunately, many people expect investing to work the same way. They buy an investment on Monday and hope to double their money by Friday. When that doesn't happen, they become impatient. Some sell too early. Others jump from one investment to another, constantly chasing the next big opportunity. But successful investors know that wealth isn't built in weeks, it's built over years. The second mistake is spending every dollar you earn. Many people receive a pay raise, only to increase their spending at the same pace. They move into a more expensive home, buy a newer car, upgrade their lifestyle. This is known as lifestyle inflation. Instead of using higher income to buy assets, they use it to buy things that lose value. As a result, they may earn more money than ever before while still feeling financially stuck. The wealthy often do the opposite. When their income increases, they increase their investments first. Then, if there's money left over, they improve their lifestyle. The third mistake is investing without learning. Some people follow trends because they saw a social media post or heard a friend talking about a guaranteed opportunity. But investing without understanding what you're buying is like driving through an unfamiliar city without a map. Education is one of the safest investments you can make. The more you understand business, finance, and investing, the better your decisions become. Knowledge reduces costly mistakes. How you can start building capital growth. By now, you might be wondering, this all sounds great, but where do I actually begin? The good news is that you don't need to be rich to start. You simply need a plan. Step 1. Spend less than you earn. Every investment begins with money that isn't spent. If every dollar disappears as soon as you receive it, there's nothing left to invest. Creating even a small monthly surplus is the foundation of capital growth. Step 2. Build an emergency fund. Before making investments, it's wise to have savings set aside for unexpected expenses. Life is unpredictable. Unexpected medical bills, job loss, or emergency repairs can happen at any time. Having an emergency fund helps prevent you from selling long-term investments during difficult times. Step 3. Invest consistently. One of the greatest advantages you can have isn't a huge amount of money. It's consistency. Even small investments made regularly can grow significantly over long periods. The key isn't investing perfectly. The key is continuing to invest. Step 4. Continue learning. Financial markets change. Businesses evolve. Technology advances. The people who continue learning often make better financial decisions than those who stop educating themselves. Read books. Watch educational videos. Study successful businesses. Learn how investors think. Every lesson improves your financial future. Step 5. Think long term. Perhaps the most valuable habit of all is patience. Imagine planting an oak tree. For years, it seems to grow slowly. But over decades, it becomes incredibly strong. Capital growth works the same way. Time is often more powerful than trying to find the perfect investment. The bigger picture. Capital growth isn't really about becoming rich overnight. It's about creating choices. Imagine reaching a point where you can choose the work you enjoy. Travel without constantly worrying about money. Support your family during difficult times. Help causes you believe in. Start the business you've always dreamed about. Financial freedom isn't just about having more money. It's about having more options. And capital growth is one of the most reliable ways to create those options over time. Every investment you make today has the potential to shape your future. Every financial decision becomes a vote for the life you want to build. The question isn't whether capital growth works. History has shown that it does. The real question is whether you're willing to be patient enough to let it work for you. Final thoughts. Let's take a moment to remember the biggest lessons from today's video. Capital growth means your assets increase in value over time. Income helps you earn money. Assets help you build wealth. The wealthy focus on owning valuable assets instead of constantly buying liabilities. Building wealth doesn't require perfect timing. It requires consistent action. No matter where you are financially today, the best time to begin learning and investing is now. Your future self will thank you for the decisions you make today. Remember, every successful investor started as a beginner. Every successful business started as an idea. And every journey toward financial freedom begins with a single step. So don't wait for the perfect moment. Start building your future today. Knowledge creates opportunity, but action creates results. If you learned something today, subscribe to Owl CEO Academy for more business and finance lessons. Thanks for watching, and I'll see you in the next one.